Hello and welcome back to All Things Money. I'm your host, David Blain. During this 100th anniversary show today, we're going to wrap up this segment, our third segment for the day, wrap up our discussion about portfolio construction and the individual investor. It's probably one of the most difficult things to do. Picking stocks or bonds or real estate, the actual investments is very difficult, but is easy in comparison to trying to match the portfolio to the psychological makeup of the investor. And obviously we do this for clients, but if you're investing on your own, these are some things that you want to take into account. So there's four main things you have whenever you're investing your money in some endeavor. You're looking for a return on your money, or maybe you're looking for just a return of your money, but you have some sort of return objective, whether that be 2% a year, 2% over inflation, just to get your money back. Maybe it's some benchmark such as the S&P 500 or MSCI World or something like that. But you have some sort of return objective that you desire to return. And so the return objective is broken into that. The first one being your desired return, what you want to achieve with your money. The second return is what we would call your needed return. And this is very important that you figure out what you need. So for example, if you are trying to save for financial independence or your kid's college or what have you, you may want to earn 10% a year, or you may want to just make 2% a year. But you need to somehow calculate what the required rate of return is. And so whatever financial goal you're attempting to meet, you're going to have a required return, and then you're going to have a desired return. If we flip this risk-reward coin over to the other side, we have risk. And this is probably much more difficult than the other. I mean, some people, it's very easy mathematically to compute what your required return is. Well, not easy, but with computers, it's a doable equation to figure out what your required return is. Desired return, most people either have a desired return or they have no idea. So that one is not difficult. But when it comes to risk, this one is very difficult to determine. And so each person is going to have what we call a capacity to assume risk, as well as a willingness to assume risk. And we'll save willingness for last because that's the most difficult. Your capacity to assume risk is determined sort of by where you are in life. If you have a government pension, if you have a big inheritance coming your way, if you have no children, if you have no debt, these type of things lead one to say that you have a very large capacity to assume risk. If you're young, you have a stable job, no children, you have a very large capacity to assume risk. On the other side of the coin, if let's say you're married and you have a number of children that you've got to get to college, they're dependent on you. You work in, say the auto industry that are always laying off, firing people. Your parents are elderly and you're going to have to take care of them, et cetera, et cetera. You have a very low capacity to assume risk. And so your capacity to assume risk can be assessed both by yourself internally as well as someone from the outside looking at your situation and kind of getting a subjective or objective view. Both. It's a little bit of both, a little subjective, a little objective view of your ability to assume risk. You either have a large ability or a small ability. Then we come to willingness to assume risk, and this is really the psychological makeup is, are you willing to assume risk? Do you flip out if your monthly statement comes in and it's, down $100,000 or $1 million in a month, which can happen? Do you get upset if the market goes up a lot and you don't go up a lot? These all tie into your willingness to assume risk. And we use a risk tolerance questionnaire called Phenometrica that is pretty good. It's probably the best one out there in existence today, but it's not perfect. It's very difficult to ascertain someone's risk tolerance. And so now we have these four pieces of the puzzle, and I wish I should have brought a graphic for you to see, but we have, in this column you have risk items, your willingness to assume risk and your capacity to assume risk. In this column, you have your return items, your desire return as well as your needed return. And if we go horizontally across it, that in our office, you typically have the client picks the desired return and the willingness to assume risk. That's what the client decides. The advisor helps the client determine, well, what's your required return and what's your capacity to assume risk. So if you work with our firm, we help you figure that out. If you're doing this on your own, you sort of have to figure out all four boxes. So what comes out the other side when you put all these inputs in, what comes out the other side is this portfolio, which is a mixture of different types of investments that have different risk and return characteristics that when aggregated together attempt to meet your desired return, they attempt to meet your required return, they attempt to take into account your capacity to assume risk, and they attempt to meet your willingness to take risk. So it's a very difficult process. You're dealing with a lot of subjective factors that go into this to try to create a portfolio. And once you create that and the first monthly statement comes out, and you have the reality of going through time with that, you have to adjust it as you go along. Sometimes people, they become very anxious about their portfolio either doing not as well as they thought or not as well as the market or something like that. And so you have to adjust this process as you go along. It's been my experience, though, that of those four boxes, the willingness to assume risk, number one, is the most difficult, but it is the one that trumps them all. That if people have a required return, that they're willing to cut back on their goals, maybe work a little bit longer, things of this nature. But when it comes to that risk tolerance, they just are really not willing to violate that risk tolerance. So that's my best advice when you're designing a portfolio and trying to figure out what type of portfolios. Look at those four factors: your desired return, your required return, your capacity to assume risk, and you're willing to assume risk. And that's your best bet for coming up with a portfolio that you're going to be happy with and going to be able to live with. And just to recap, also if you missed the first part of our new and improved three-legged stool, go over to the web, www.dlblain.com, and listen to that. We covered in the first two segments of the show about paper assets, income-producing real estate, and ownership in a private business. Well, that's all the time we have for today. I hope you enjoyed our 100th anniversary show today and that you'll join us again at the same time next week. For All Things Money, I'm your host, David Blain.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.